Okay, let's just jump right into it because something incredible is happening in the stock market. You've got artificial intelligence, which promises to change literally everything. And of course, investors are pouring billions and billions of dollars into it. But the hype, the gigantic valuations, doesn't it all feel just a little bit familiar? Make no mistake, what we're in right now is a full-blown AI gold rush. The numbers are absolutely staggering. I mean, the investments being made here are reshaping the entire US economy, and they're pushing the market to some pretty dizzying new heights. To try and wrap your head around this, just look at one company, NVIDIA. Now, they're not even making the AI itself. They're making the picks and shovels for this gold rush, the super powerful chips that make it all work. And they're so important that at their peak, the company's value shot past an almost unimaginable $5 trillion. Just let that sink in. And here's where it gets kind of wild. This concentration of power is, well, it's pretty much unprecedented. There's this tiny group of tech giants that everyone's calling the Magnificent Seven, and they now make up more than a third of the S&P 500's total value. Think about that. Their performance is the market's performance. So you've got this insane level of market concentration, and it's all being driven by this single world-changing story. And you just can't shake the feeling it feels eerily familiar. Which leads to the big question for all of us, right? Have we seen this movie before? To even begin to understand what might happen next, we've got to hop in the time machine and rewind the clock about a quarter century. We're going back to another revolutionary technology that promised to change the world, the internet. You see, today's Magnificent Seven are pretty much the 2024 version of the Four Horsemen. Those were the tech darlings that were leading the charge during the dot-com boom. We're talking different names, different tech for sure, but a very, very similar story of a few companies dominating everything. And this brings us to what might be the most crucial lesson of all. The story can be 100% right, but the investment can still be totally wrong. The dot-com narrative, it came true. The internet really did change everything. But the stock prices had gotten so far ahead of themselves that it took more than a decade for a lot of investors to just get their money back. And this is just a perfect illustration of how brutal technological disruption can be. I mean, remember BlackBerry? In 2009, they were on top of the world, untouchable. Just 4 years later, after the iPhone showed up, their market share basically vanished. Poof. It's a harsh reminder, today's innovator can easily become tomorrow's dinosaur. So, okay, we've got the stories, we've got the parallels, the vibes feel the same. But how does the AI boom really stack up against the dot-com bubble when we look at the cold, hard numbers? Now this chart, this shows something pretty startling. Just look at the green line. At the very height of the dot-com bubble, the 10 biggest companies made up about 25% of the market. And today, that number has rocketed to nearly 40%. Our market is way, way more top-heavy now than it was back then. And just like back in the dot-com days, the performance of the entire market is hanging on the success of these few giants. I mean, look at this. Over 60% of the S&P 500's recent returns came from just 10 companies. That is a huge dependency. That's a lot of eggs in one basket. The parallels start to get even spookier when you compare the companies one-on-one. So what you're seeing here is NVIDIA's stock chart right next to Cisco's from the late 90s. Both were the picks and shovels of their time, and their stock charts, well, they look almost identical. It's like a historical echo. But, and this is a really big but, there is a crucial difference, and it's all about profits. You see, at its peak, Cisco's price-to-earnings ratio was a crazy 196. People were basically paying for pure hope. NVIDIA, on the other hand, has seen its PE ratio actually go down. And why is that? Because its earnings growth has been so mind-bogglingly explosive that it's almost keeping up with its stock price. It's still expensive, yeah, but it's backed by real, incredible profits. And that is a key distinction. So what happens if this whole thing is a bubble? Well, because these few massive companies are so interconnected, experts are warning that if it pops, the collapse could be fast, and it could be painful. And look, it's not just the usual skeptics saying this. At a recent summit at Yale, 40% of top CEOs said they think a correction is coming soon. You've even got the CEO of Goldman Sachs out there warning people that a lot of this AI investment is just not going to pay off. So what would be the pin that actually pops the bubble? Well, analysis points to three main possibilities. First is just contagion. One company stumbles and it creates a domino effect. Second could be some kind of governance failure, a scandal that shatters trust. Or third, and this is the really ironic one, what if a new, even better technology comes along and makes today's AI look old? This comment from a user on Reddit, it really just nails the anxiety that people are feeling. There's this growing sense that so much of our economy is being propped up by this massive AI-fueled building boom and a deep fear that it just might not be sustainable.
And that anxiety brings up the big question, right? With all these risks out there, what in the world is an investor supposed to do? So let's look at a few ways you could think about navigating a market that seems to be running on pure, uncut hype.
Broadly speaking, there are really three schools of thought here. First, you can just ride the wave. Go all in with the market leaders and sink or swim with them. Second, you can do the complete opposite. Avoid the hype entirely and focus on old-school value stocks. Or there's a third way, a kind of middle ground, where you invest based on a company's actual economic footprint. Things like sales and cash flow, not just its skyrocketing stock price. And you know what? History gives us a pretty powerful clue here. This chart shows what happened during the dot-com crash. If you look at that solid black line, you can see that the balanced, fundamentals-based approach ended up outperforming. It didn't have the crazy highs, but it also missed the gut-wrenching lows. It was just a much smoother and, in the end, a more profitable ride through all that chaos.
Ultimately, this isn't about having a crystal ball and perfectly timing the market. Nobody can do that. It's really about deciding on an investment philosophy that you can stick with, one that can handle all this uncertainty.
So what's the real takeaway here? It's that powerful stories, big, compelling narratives are what fuel markets. The internet changes everything was one of them. AI changes everything is the one we have now. But the one thing you have to remember about these stories is that the final chapter is always, always unwritten. So that leaves us with this really complex picture. Today's market is more concentrated, for sure, but the companies at the top are also making way more money than their dot-com cousins did. The story is just as compelling, and the risks feel just as real. We all know that history doesn't repeat itself, but it sure does rhyme. So looking at all this evidence, the question for every single one of us is, what verse of the song do you think we're in right now?